So good morning everyone, and a very warm welcome to today's webinar on the future of sustainability in business, why success depends on integration. And this webinar is hosted by EY and ecoDa. The omnibus regulation has created confusion and may undermine the clear value that sustainability report can offer to companies. That said, the momentum around sustainability isn't slowing down. Even if the EU regulations are delayed or adjusted, market expectations and global standards will continue to push business forward. In addition, we should not underestimate the fact that many companies are strong believers in the value of sustainability and are proactively embracing it as a core part of their strategy. Our focus today won't be on regulation, but rather on how sustainability can remain a practical tool that really can help companies manage their operations more effectively. We will begin with a presentation of the findings from a recent EY report delivered by Gillian Lofts, EY, a global sustainability finance leader, and then Andrew Hobbs, partner at EY, will lead a panel discussion on how companies can go beyond compliance and fully integrate sustainability into the core strategies. Thank you for joining us, and we are looking forward to an engaging and insightful conversation. We rely on you for questions, so feel free to raise any question that you would like to ask to our panelists using the Q&A mode. So Jill, please, the floor is yours.
Thank you very much. I know that you can't see me. I've got a little bit of a technical issue, but I believe you can hear me and you can see the slides. Thank you so much, Beatrice. It is lovely to be with you all today. I'm Jill Lofts. I look after sustainability within the financial services sector at EY globally and in EMEIA. And I have about 10 minutes to talk us through the highlights of our latest EY long-term value survey, which we undertook in January this year. This is the 5th edition of the survey, and we surveyed 200 of Europe's most senior business leaders, both non-executive directors and chairmen, and of course executive directors, CEOs and C-suite members, covering all of the EU states plus Norway, Switzerland and UK. And I think there's a lot to dip in to this year's survey, and particularly given the geopolitical backdrop. I think some of the findings I personally found super interesting. So I'm just going to take you through the highlights. Overall, I would say that we found a significant gap between sustainability strategy and business strategy, that sustainability in general continues to be siloed, and actually also that boards and management don't see eye to eye, don't have the same perspectives on sustainability. The second macro point is that the research highlights that this is actually a mistake, that companies that do integrate sustainability into their business are actually more confident about their outlook and more confident about the outcomes of their strategy. So, of course, the final part of the report, we draw on ways in which firms can integrate sustainability into the strategy. So I'm briefly going to go through an introduction of the sustainability integrators, which we see very much as those leading edge firms on sustainability. Secondly, how companies are feeling the pressure to be more sustainable. Thirdly, why misalignment is making sustainability more siloed. And then finally, how companies can better integrate sustainability. So if we pop to the next slide, let me introduce you to the sustainability integrators. And I appreciate this is a very busy slide, so I'm just going to pick out some highlights here. So 27% of our sample we would put into the category of leading edge around integrating sustainability. And the types of characteristics that we see of these firms, they're 1.5 times more effective at achieving their sustainability goals. They're 40% more confident in their business outlook. Their boards are actually more aligned than the rest of the sample. They're more accountable and they feel better supported by technology and finance. So there's a heck of a lot of positivity coming out of this. The sustainability integrators are nearly twice as likely to report higher than expected financial value from their sustainability initiatives. 94% of integrators believe sustainability contributes directly to profitable growth, not just compliance or reputation. And I think we see this characteristic more and more in this backdrop where thinking through the commercial reality of sustainability. 43% of companies are integrating sustainability. So 43% of companies that do integrate sustainability report better innovation in new products and services. And for me, this was a real standout point, that they are embedding sustainability into product design, into circular economy models, supply chain collaboration, driving both environmental and commercial outcomes. And as I said before, thinking through the commercial reality of sustainability and how that plays into product innovation and service innovation, I think is a really positive finding. Investment decisions are evaluated through a dual lens for the sustainability integrators. So they look at financial performance and sustainability impact. They don't take one or the other. It's an integrated approach. So if we pop to the next slide, let's talk a little bit about overall, and the one after, if you don't mind, thank you. Let's talk a little bit about overall the pressure that firms are facing. And this comes from a range of sources, as you can see on the slide. Over the past 2 years, firms reported, so 91% said that they were feeling pressure from investors to accelerate their sustainable business practice. 39% said that they'd suffered reputational damage due to falling short on sustainability standards. And interestingly enough, that 39% represents the whole sample. Only 6% of the sustainability integrators said that they'd felt reputational damage. So, a huge contrast there. 29% said that they had faced activist disruption. So the overall picture that I wanted to describe on this slide is that there are multiple stakeholders, both internally and externally to the firm, where firm is feeling pressure from these stakeholders to do more on sustainability. We can see here employee pressure is significant, supply chain, government and customers. So lots of different stakeholders who are keen to see firms do more on the sustainability agenda. Let's move on to the next section. I mentioned we would talk about the misalignment in terms of integration of sustainability into the business, into the strategy, and into the board. And one reason that we see that sustainability is getting sidetracked is that it seems to be struggling to build its profile within the business. Only 18% of companies said that their sustainability strategy focuses on long-term issues, and only 19% said that it aligns with their wider business purpose, which is quite concerning. But actually even more concerning is the disconnect between boards and management on business, as this slide indicates. So as you can see there, 82% of board members believe sustainability is not integrated into strategy, whilst this was the view of only 26% of the CEOs and C-suite leaders that we interviewed. 81% of board members felt that when they needed to make cuts in sustainability initiatives, they're more likely to be wound down than business initiatives. And only 33%, as you can see on the right-hand side here, of CEOs felt that also to be the case. Nearly 50% of board members felt that sustainability takes second place to other business priority versus only 30% of CEOs. So this slide gives you some kind of idea of, as we're saying, this disconnect between how the board feel the firm is doing on sustainability and how the executive and leadership of the business feel they're doing on sustainability. And we very much see that disconnect as one of the key issues for integrating sustainability into the overall strategy. If we go to the next slide, thank you. So let's just, again, a very busy slide, but let me just give you the 5 habits that we have observed in this year's survey. The first one I would say is alignment, and I've mentioned this already. So ensuring that the board and management are aligned on sustainability. Secondly, accountability, ensuring that everyone on the board, not just one leader, is responsible for the sustainability issues. Thirdly, understanding, making sure every function understands that the business benefits of sustainability will benefit all of the functions. Finance, so encouraging the integration of sustainability by getting the right finance and the right financing framework in place. And last but not least, technology. So investing in technology programs that will support the delivery of the integrated strategy. So this is a real whistle-stop tour of this year's survey. As I said, I think some really interesting insights around how sustainability is integrated into your strategy or not, how it is integrated across the business or not, some of the real benefits of integrating into your strategy and across the business. And the real standout there was product innovation and service innovation. So I think some rather compelling findings for me, indicating that sustainability is not just about what is delivered, it's about how we deeply integrate sustainability into the heart of the business. So I'm going to finish there. Thank you, everybody. Please do pick up the survey, and I'm very interested to hear what our panel will cover and their comments in terms of their lived experiences. So over to you, Andrew.
Thanks very much, Jill, for that very clear summary of what you've said is a pretty content-rich survey with a number of surprises in it. Hello, everyone. Thanks for joining today. I'm proud to be able to moderate a panel discussion now on the findings and some reflections on what Jill just covered. And to help me do that, I've got 2 fantastic panelists. The first is Sandra Gobert. Sandra, I think, will be well known to many of you. She is the Executive Director of Guberna, the Belgian Institute for Directors, since 2019, as well as taking her own medicine by becoming a certified director of Guberna herself. Since May 2019, she's been an independent director of Fluxus Belgium SA and sits on the board of ecoDa, who is one of the obviously one of the conveners of today's webinar, where she specialises particularly on ESG matters. Joining her is Fiona Watson. Fiona is the Vice President of Corporate Performance and Accountability at the World Business Council for Sustainable Development, where she oversees programs that align resource allocation with sustainable performance. Her work covers strategy, performance management, corporate reporting, and financial markets, and she works with executives from WBCSD's 250 global members. She's got a background in US and UK capital markets law with over 25 years experience, including a decade in banking post-financial crisis, where she came across or first touched sustainability in the form of TCFD, which will be a well-known reporting framework to many of you, and also roles at Amazon, which included integrating sustainability criteria into the business. She's based in Amsterdam, and she advises organizations like ITPN, the Value Balancing Alliance, and the Capitals Coalition. And most recently, she served on the EU's EFRAG Sustainability Reporting Technical Expert Group, or SRTEG for short. So welcome to both of you. I'm going to kick off with just asking you to do a couple of reflections, and maybe I will start with Fiona. I mean, what you heard a lot there from Jill. What particularly stood out for you based on your experience of this agenda, Fiona?
Yeah, thank you, Andrew. Hello, everybody. Great pleasure to join you this morning and reflect on these really interesting insights that you and your colleagues have unearthed through extensive research over the beginning of the year. I think some surprising, some not so surprising, based on the work that we're doing. In summary, when they see it, they see it. So when they've done the work and they've managed to integrate it into organizations, you see those integrators getting the recognition from investors, getting the integration into CapEx, and staying the course. And that certainly resonates with the discussions we've been having with member companies and more widely, that notwithstanding these headwinds in Europe on the omnibus and elsewhere, the business case, once it's clear, is one that companies and boards are clear to stick with. They do, however, see some quite surprising aspects on that disconnect, how there can be such a stark disconnect between boards and executive teams. It does make you wonder, what are the discussions, what are the committees, and how are they approaching these things? What perspective are they taking on it? And how are they unpacking this quite complex conceptual agenda into understanding what it means for risk, what it means for opportunity? So how is that integration happening? So I think, as Jill said, it's that stark misalignment between boards and executive teams, which is the main surprise, and then very reassuring and validating to see that when the integrators, as you define them, are able to get up that curve, that they're seeing the value in the agenda and sticking with it. So both surprising and not surprising in those two dynamics. But interested to hear Sandra's perspectives.
Yeah, thanks, Fiona. Sandra, yeah, what did you find interesting or surprising?
Yeah, thank you. And so also very happy to be here. Thanks for the invitation and for sharing the very interesting report of EY with us. I think, and I think it's something we did not explicitly found in the EY report, but I think we also have to keep in mind that there is a difference between different sectors. The approach to sustainability is, in my opinion, in what I see in the boards I'm sitting on myself, as for instance the Fluxus board, as you mentioned, Andrew, but also the boards we come across with the activities of Guberna, or the boards also I come across because I'm also chairing the sustainability awards jury in Belgium. So what we see is that there is a difference in the approach depending on the sector, because for some sectors, of course, sustainability is a must. The transition of the business model is a must. So they have to have a more strategic approach, and it does not necessarily make the exercise easier, but of course it makes it more necessary. It doesn't make it easier, but because people never like change, they fear the unknown, so they fear this too. But it's a necessary necessity in the long run, and so this is the traditional climate sensitive sectors that are highly vulnerable to climate change. They cannot escape, they can win time, and so what we see now recently, I think starting from 2024, is that we notice a slowdown also in the transition of the business models, thanks to the regulation pressure, geopolitical market uncertainty. So investments are put on hold. And one of the main elements there also is that they do not always understand the link between financial accounting and the non-financial accounting that is made compulsory by CSRD. So the impact of non-financial accounting of CSRD on the financial accounts is not only is not always sufficiently known. But we see since 2018, I think, in general, we see that there is a progress made in the governance of sustainability. And I think that's also what your report is showing. And I see there three fundamental elements. I see first that in boards of directors, the expertise is growing, even if there is still a gap with the management. And we are moving within boards from some individuals on boards that have sustainability expertise to a more overall sustainability expertise. So from champions to more mainstream expertise in the boards. We also see more awareness in the board. So of course, this comes together. And then we also, what we have seen is that the reporting obligations have pushed the companies forward. It placed the topic of sustainability on the agenda of the executive committee and of the board. Maybe it was there also already, but now it placed it there in a regular and a structured manner. It also made it possible, I think, to mobilize the company as a whole, and so move a little bit away from the silos your report is mentioning, so including procurement, HR, legal, etc. And then the audit, the compulsory audit also gave the exercise some credibility. It gave the data credibility, gives the data credibility, but it also gives the process credibility. I don't think the audit committees would take it so seriously if there was no compulsory audit. And also, I think that's a last element. It makes it possible to check, and it also lessens the risk of false sustainability allegations of some actors on the market. So I think there's a difference between the sector. It is easier. It is more strategy linked within the climate sensitive sectors, but it is as important in all the other sectors. And so I think we must keep on highlighting that.
No, thanks, Sandra. I mean, just before, as we were preparing for this webinar, you asked about the data that we'd surveyed and whether the sector split gave any insights, and the samples weren't statistically significant. So what I'm about to say you should take with a pinch of salt. But out of the sectors we looked at, the ones that were most likely to have integrated strategies were consumer health and also financial services, perhaps financial services driven by the regulatory agenda. I don't know. What was surprising is that energy was very low down, but as I say, perhaps that's to do with the few samples that we had. I think it'd be interesting in future years to perhaps pick a couple of sectors, maybe 2, 3, to precisely with the purpose of identifying that where climate ones are more or there are more climate sensitive ones, that we get different readouts from ones that are less climate sensitive. But let's see.
Yeah, that would be interesting indeed. And I think Fiona also highlighted the importance of consumers as drivers and the financial sector. I think they are moved by regulation mandates, and they have to finance the whole transition. So it's for them, it's like a natural process. Huh?
No, I agree. I agree. Let me pause and also just say to our audience, please use the Q&A function if you want to ask our panelists or indeed
regarding the energy sector, Andrew, I can come back to that later if you want to, when I will be talking about the Fluxys example, because I think the energy sector has been moving through some very intense times lately, and so sustainability is also about balancing long-term and short-term and prioritizing long-term over short-term. But in some cases, if there is no short-term, there is no long-term either. So it's I think it's it might be an exercise to redo in 2-3 years, I think. But I will come back to that.
No, for sure. Thank you. Let's turn back to Fiona. Fiona, in your initial remarks, you're clearly sold on the kind of the benefits of integrating sustainability into strategy. You work with more than 250 members of WBCSD. How do you reflect on the kind of the incorporation of sustainability in those companies that you're involved with? perhaps you can compare and contrast a few.
Yeah, happy to. It's also hard to generalize because those 250 are across multiple sectors and multiple geographies. So they don't overlap directly with the scope of your report. So perhaps dialing out and taking that more global perspective, you do see a difference. And I think we can also generalize in a way that doesn't attribute change to CSRD or not. It does impact, CSRD is expected to impact roughly about 75% of our members, wave 1, wave 2, and certainly wave 3. So it's a factor, but it's by no means the only factor. And I think if I was going to distill it down into one word, it's culture that comes through. And culture is obviously a very one word that connotes a vast complexity of different contexts, but it's I think the defining factor is the willingness of boards and executives to learn and to be receptive to understanding what these changing physical environment means, the changing operating environment means, for them to be able to, with the support of their executives and management teams, understand how that translates into impacts, risks, and opportunities. And you see that in the integrators, with 90% of the integrators having an understanding of what that impact, risk, and opportunity. But they need to be receptive to that. And it does require new ways of working and new ways of thinking. And understanding data, particularly quite immature data sets, that many of these executives and board members are not used to dealing with. We talk about making non-financial data finance grade, and whether or not that's the actual objective, it does indicate how much of a journey we need to go on to be able to understand and really integrate these criteria into decision making. So I think it's culture, it's context. And so here, in the context of compliance in particular, the companies who are really getting ahead, and this might be trite, they're not treating it as a compliance agenda. They're taking the time. It might be the driver. So as Sandra was saying, it helps, it's a leveler, it gets it on the agenda. So whether or not you were leaning into the sustainability agenda or not, you now have to, or are forced to consider it in a reasonably structured way. But the leaders are unpacking it and understanding what it means, again, for impact, risks, and opportunities. So that's where there's a couple of examples, like a fertilizer company that has completely transformed their business model based on their initial TCFD report. So before they were even reporting, the board took the outputs of that initial exercise 5 years ago and looked forward to what that was going to mean for their business model and started putting in place processes, governance structures, and capital allocation and investments that have allowed them to pivot very quickly to a different business model. And you've seen that there are a number of different instances, and Ørsted is the classic example. But we see that happening a lot, and it's happening at speed now, based on, again, see in the CSRD context, the double materiality assessments are coming through, and the CSRD scope for Wave 1 companies has required companies to look at data in a different way. So it might be data that they had already, but they're now looking at it differently, and they're integrating it differently into their processes. So chemicals sector, for example, that may not have looked at water usage and outflows in the way that they're now required to. And it opens their collective eyes on what that means for their business model and how they can put in place mitigating strategies. And that then feeds a culture and a feedback loop internally that supports further integration. So it gets them going, it mobilizes. But all of that is happening within a culture where there's leadership, there's a willingness to learn, an ability to translate these abstract concepts of climate and nature into real clear drivers of business value and risk. And we see that happening too in the investor community, which I think we'll talk about later. But overall, therefore, a recognition that it's not compliance, and this signals a real opportunity for them to stand back and reflect on where the company has come and where it's going in light of these changes. So that would be very much what I see as a defining factor globally, as well as within Europe.
Fabulous. I want to move off the regulation point after this next question, maybe look at the other pressures that because that was one of the strong things that came through in the survey. For me, given it was in January, after the change in the US administration, that the companies surveyed were saying that they were feeling pressure from multiple sources to become more sustainable, and we will come on to investors. But just staying on the regulatory tip for a moment, Sandra, you would, in your last remarks, were talking about how you'd seen the governance around sustainability improve in companies. Talking to some clients when Omnibus came out, that there seemed to be a kind of some questions being asked higher up the organisations, sort of saying, should we just stop and put everything on hold, given that there are other pressures and other priorities? What do you say about kind of this concept of should companies be using reporting obligations to drive the strategy, or should it be the other way around? A bit of a leading question.
Can you repeat the last part of the question, Andrew?
So the point was, should the kind of the compliance agenda, or the lack thereof, be driving the strategy?
It's an interesting way to put it. I think the initial objective of the regulation was not compliance. I think we made it that way, and we are, I mean, legal people and auditors and maybe also part of the sustainability teams in the companies, because they used and they legitimately used CSRD to move the sustainability transition forward. And I think the challenge is that we move beyond the compliance. The objective of the Green Deal was never compliance. They never said we're going to make a Green Deal to give more work to legal teams and to auditors. I think the objective was sustainability from the beginning. And if you look at a high level, and that is what board should do, you look at the regulation from the helicopter view of the board, you see that taxonomy is about classifying your activities, saying the activities are sustainable or not sustainable. CSRD is about looking in detail at your strategy, saying these are my risks in terms of sustainability, and these are my opportunities. So you're looking really, CSRD obliges you to look at your business model, and then CS3D obliges you to implement it in the operations and in your processes. So the objective of regulation was never compliance. It always was sustainability. So I think we should use the delay that has been created now, the delay of 2 years, to move back to this initial objective and to move back to the real integration of this in the strategic reflection of the board. And so I think we should also be prudent with the simplification of the legislation, because simplification cannot again become an objective in itself, because I think then we're making the same mistake or the Commission is making the same mistake as it did in the beginning. Also, the simplification should make it possible to move forward with the strategy. So I think deregulation and too much simplification would not be good for anyone. And I think the result of your report confirm it. All stakeholders expect to move forward with sustainability. So I think we should keep going forward and use the delay that has been created to move forward based on voluntary reporting whenever necessary. But the reporting comes afterwards. The awareness that has been created should be used now to integrate it in the strategy of the companies.
Yeah, no, and thank you, Sandra. You make a great point that to remember what the original objectives of the Green Deal were, and to a large extent still are, with the Commission really just saying, well, we're going to use different tools now to achieve our net zero and other social objectives. Thank you.
Andrew?
Yes.
Can I just, before, I know you want to take us off compliance.
No, carry on. No, please.
Before we do,
please, yeah.
I think Green Deal was part of it, but by no means the genesis of it. And I think just like to underscore the value that this compliance agenda brings in getting us all talking a common language, which is what it's trying to do. We can talk about financial performance in pretty comparable, consistent ways. We can't yet do that on sustainability-related performance, even in a financial context. So I think it's very important that we grasp the value of that global baseline, that common language, to be able to understand what it means, because that's critical to be able to get incentives aligned to support it. And that's one of the challenges we've seen with reporting voluntary frameworks. We've seen different sectors, different companies talking different languages with different definitions, different baselines. And it's very, very difficult to get a systemic understanding of what is going on. And I think it's that systemic understanding that we also need to keep in mind for what we're dealing with here. This is not a desktop exercise. We are dealing with a planet that is telling us that we are living way beyond its means, planetary solvencies, planetary boundaries, whatever you're talking about. And we urgently need to address that because that is creating systemic risk. And you mentioned in the intro that I came into sustainability through TCFD. Well, that was the work of the Financial Stability Board after the first financial crisis, which I had a ringside seat on in banking, because of the systemic risk that this agenda presents. And the Green Deal, to a large extent, has also been responding to that systemic risk. So I think it's that broader systemic risk that also presents opportunities, and the opportunity thereby to come to talk to a common language, which is where I think you're going to go to next in terms of how we can take this forward and how it is broader than just regulation, and how we can move towards that common language and who has a vested interest in making that happen.
I totally agree with Fiona, and that was what I was referring to earlier. What I said, they're still not making the link between the non-financial accounting and the financial accounting. CSRD is the non-financial accounting, and this link, the impact, the financial impact, and the impact on financial performance still has to be made. So I think that's it's a very important one, and that's to really go to the transition of the business model. Everything has to come together.
Good points, well made. Thank you for clarifying that, Fiona. Let's talk about pressure now. I mean, as I sort of said earlier, I was pleasantly surprised by what the data was telling us in terms of what stakeholders were telling the companies we surveyed that they wanted from them on sustainability. And as we just discussed, regulation is just an important but a small part in the overall goals and objectives. Fiona, any reflections on kind of the data that Jill presented, particularly investors?
Yeah, well, based on my prior comments, I'm not surprised at all. And the financial sector has experienced the first real wave of regulation, particularly in Europe, which has driven a kind of top-down approach from systemic risk. So you see investors at the front door. I mean, I'm pleasantly surprised at how high that is reported at. I think 91% felt they're getting increasing pressure. Slightly disappointed that doesn't yet seem to be turning into action. So there is still a disconnect there. Maybe it's partly that financial connectivity point. And also I think signposting, because here we see with members again and again is where can you get the business case? So investors won't give you the business case. Investors will respond to a business case. So where can corporates, I think this is a real challenge for management teams and boards now. What is the business case for sustainability? How can you confidently invest the type of CapEx that is on the cards for many companies and feel that you are doing that in the interest of the company in the way that it's often interpreted? And that is very challenging. You see some green shoots, and the context in which this agenda is developing is moving very, very fast. And where I've seen, probably in my own experience, the most effective rapid levers for change have been through B2B pressure, so customer pressure. And where you've seen large corporates in the B2B value chain turning around and saying, this matters. We expect you to do better. We expect you to give us better data, to be more transparent about your impact, because we're going to report on it and it matters to us and it matters to our stakeholders. So that B2B value chain and the ripple effect that has is a very, very effective lever for change. And in parallel with that, public procurement. You've seen whole markets shift as governments have indicated that sustainability, particularly climate, is going to come into their decision making. We saw it in the UK. It had temporarily an effect in the US. So that public and B2B procurement signposting is very, very important. In the retail markets, it's much harder for companies to navigate because there aren't consistent signposts. Customers will say they want it, but they don't want to pay for it. And until we get around this conundrum of how you can pay for sustainability, there is a bit of a swirl happening there that we're spending quite a lot of time working with corporates on, is that the valuation, the quantification, so how you can get these factors priced in a way that's going to allow the type of investments that are needed to create the products and the services that customers want to see without the price inflation that many of them are associated with. But you do see demand for it, which I think Sandra mentioned this earlier, has created a bit of noise. And here we have this trust dilemma that's gone on, because you have seen a lot of opportunistic behavior, commercial behavior in this space, and that's taken advantage of the absence of a clear framework for a clear accountability framework for what is sustainable and how we're measuring sustainability performance. So in the absence of that clarity, we have seen a huge surge in green claims. And the Commission did research where they found over 50% of green claims at some point in time had absolutely no valid source at all. So that trust dynamic is playing into particularly the retail space, but it's also relevant going back to the capital markets, where you've seen investors, and we all have this as individuals, so investors seeking to drive their investment portfolios in a more sustainable direction, but unsure of how to do that, now confronting a lot of noise around greenwashing and increased regulation in that space. So there are a few challenges to overcome. There's the business case, there's the clarity. Again, I think regulation has a huge role to play in bringing that consistency to the measurement and the performance element. That ultimately will help us get us more aligned. So there will be more consistent alignment, and then the disclosure and the regulation will follow. But certainly in that customer space, that's where there's a huge amount of work to be done and huge opportunity as well.
Thank you. We've had some questions in from the audience, which is great. So I'm gonna, and they're on topic. In fact, one of the things I think were questions from Jeroen Hoyer, and hi Jeroen, glad you could join us. Is trying to address the elephant in the room, which we haven't spoke about, which is what's going on in the US. And he's asked a question, he says to either of you, which is, do you see the pressure in the US on so-called woke policies, which would include climate, spilling over negatively to EU companies? Or how do you think that the debate over there will affect things? And I just observe, okay, it was early doors, but we did do this research in January where the kind of US position was already well known. But I guess there'll be, if there is a spillover, there's a time lag. But just wondered if you, Sandra, or Fiona want to reflect on that one.
Sandra, I'm happy to make some comments, but Sandra, go ahead.
Okay. I'm happy to start. Of course, I'm only talking about Belgium. Yeah, of course, we do see the pressure in Belgium. And I'm also sitting on the corporate governance committee, so we hear a lot of, we get a lot of feedback from the Belgian listed companies that the policies are putting pressure. The first reaction is from companies is to say that. We maintain our policies. It's not because there is some special particular person with particular views on society and on the world in the White House that we all have to change our policies immediately. But still, I think companies and boards are careful. They are prudent. Of course, they are protecting their markets. They also have to protect their supply chains. It's a remark I made earlier. Sustainable value creation is about preferring the long term over the short term. But if there is no short term anymore, there will be no long term. So at a macro level, it is becoming more and more difficult to make those choices, and we see that this is weighing on board of directors. So the effect I see immediately, and of course I shall not quote specific cases, but is that some decisions, if possible, are postponed. Investment decisions are postponed. I think especially in the industry and in the energy sector also since the beginning of the year. We see a lot of investments that are postponed or investments that are rescoped. There's also a lot of rescoping. And so companies are holding their breath and waiting what is still to come. So it's also a question of postponing difficult decisions. So, but I'm also happy to, I can elaborate further, but I'm happy to have the more international view of Fiona and to see if the situation is the same in other countries.
Thanks, Sandra. How would you react, Fiona?
So I think there are some similarities in what we're seeing across global trends. I am, however, slightly more optimistic insofar as what's happening in certain jurisdictions in the US is quite localized, I would say, and has a very, very clear political agenda to it, which the market realizes. The market and BlackRock themselves are very aware of the underlying basis for their investment decisions and how they approach things. So I think the boards and companies and investors remain solid in their conviction. That is a data-driven conviction. How they talk about it and how that surfaces may change for various reasons. And on the whole, I would say that we've seen large corporates, some have made quite public changes to their strategy and have certainly not encountered wholesale support for that, to put it mildly. I think particularly in industries that have quite strong human capital, there's been very, very immediate pushback, and also companies with high brand recognition outside of the US, they've certainly experienced significant pushback from any capitulation to the US political agenda. On the flip side, there have been a number of corporates that have stood up and maintained their approach. And similarly, you can't keep everybody happy, but certainly in non-US markets, that's playing out reasonably well. So I think what people say and what they do is different, and where there's a strong conviction in the underlying strategy that maintains. I do see, picking up on your point, Sandra, that there is slightly more consideration being given to these strategies. And I think what we're seeing is sustainability is being unpacked. So ESG is being unpacked more, and particularly when you do start integrating it in the way that the report points to companies integrating it, you necessarily need to keep climate risk distinct from certain social and human capital risks. And distinct again from biodiversity. So I think once you do the work and unpack it, that agenda does disperse down into the organization more, that in turn supports a more data-driven rationale and approach for a strategy, which may or may not surface with a certain narrative in certain jurisdictions, but it's not a substitute for doing the work, and it doesn't make the issue go away.
Great point. So what you were just saying there, Fiona, reminded me of what Sandra was saying earlier in the conversation about what she was seeing in terms of the improvement in governance over sustainability, which included becoming very clear-eyed on what really makes the difference, whether that is driven by the double materiality assessment or just becoming more strategic anyway. But to add, and this is public because it's in the survey, but we interviewed BAE and Siemens on this topic, and you count them as sustainability integrators. And to your point about talking about it in a different way, they just don't talk about sustainability as a sort of separate thing. They just talk about business decisions and new products and services and circularity and making best use of resources and all of that kind of thing. So if it becomes a business conversation using the language of business and performance, the kind of some of this political issue goes away.
Very much so.
Yeah, indeed.
There's a question. I'm just going to ask. There's another question from the audience. Mercedes, you've asked a question about future-proofing governance, and I think I might leave that because I think it goes very much to the 5 tips that we have in the survey, which I was going to come on to later. But there's been a question from Antonio Fuertes about asking whether we've read a Harvard Business Review article, which we may or may not have done, but it goes to his question. It says, "You shouldn't need a business case to do the right thing," is the title of the article. How would either of you respond to that as a general proposition, which is, should we even be talking business cases? I think we may have just answered this in the last bit that we took the last question, but any reflections on Antonio's question? Maybe I'll turn to Sandra.
I'm going to reread the question.
So he said, what do you think of a recent Harvard Business Review article, the title of which is "You Shouldn't Need a Business Case to Do the Right Thing"?
It depends if it's question, I would agree with the title. I haven't read the article. If it's a corporate question, I tend not to agree. I think it's part of the role of the board to look at the business case and to make up a good business case. I think there's two ways to look at it. There's also two ways to define sustainability, and you can define sustainability according to the Groenland definition of 87, which is a macro definition, which is quite all right. It still stands the test of time. So producing for the actual needs without putting in danger the future needs. But it's not a micro definition. At a micro level, every company has to survive. It's still the objective of a company. So then you need to make the business case, of course. So I don't know if that corresponds to the content of the article, but I think that is the point of view of most boards of directors according to their roles. But I'm happy to listen to Fiona's view on that.
Yeah, perhaps not surprising, I have so much to say on this, so maybe try and distill a few reasonably articulate thoughts on this. I think I just Googled the article. I think this is one from 2017, right? Alison Taylor, NYU 2017. And I think that in the 8 years since she wrote it, the world has moved on quite a lot. And we've seen a lot of discussion and societal discussion on what the role of business is and more widely, what is the right thing. And in English, the word right connotes quite a lot of judgment and subjectivity, which is immediately challenging because the business world orientates around a rationale. And that's one of its strengths, but also one of its weaknesses. What we've seen a lot in the public discourse around the Green Deal and the CSRD and now the Omnibus points to, I think, a rising recognition that we perhaps need to reevaluate what we expect from corporations and by extension what we expect from boards and what's their role. And there's also been a lot of discussion around social license to operate. And what does a company need to do? In the last several decades, the private corporation, particularly the limited liability corporation, has been assumed to be an entirely for-profit enterprise. And so with that, you need a business case to feel comfortable with anything, any purpose that it follows. I don't think that's necessarily right. And I think we're seeing that come through again and again, that we need to think more holistically about what enterprises exist for and move away from some potentially quite limited interpretations of the role of business. And this agenda gives us very much an opportunity to do that. And I think we therefore need to work on, as we are at WBCSD, how do we evolve the context in which the business case is necessarily a broader interpretation, that the business case is not just a profit solution, that the business case is actually more about that broader purpose for the organization. And again, once we have consistent accountability frameworks, once we have a consistent language, we'll be able to more confidently define a business case in a way which will probably meet that definition of the right thing.
But it will still be a business case.
But it will be a business case because they're businesses.
Yeah.
And they have investors, and we have built a system up around the private enterprise that requires a degree of profitability or capital growth to support the pension payments that they go into. And this is a complicated system, a very interdependent system that is a very delicate balance, as with any ecosystem. So it will be a business case because otherwise, as you were talking about, Sandra, if there's no long term without a short term. And so those remain the rules of the game, at least for now.
When we did the survey work last year, one of the things that came out in the results was that boards were not getting the business cases to make investments in sustainability related projects in a way that they could feel confident. If you look at this year's survey, the sustainability integrators, and you look at the stats, they overwhelmingly said they're getting the money they need. And I think for this risk of kind of repeating this ourselves is that is because they have proved what doing the right thing means for their overall business model and strategy. It may not get to that higher purpose that you're talking about, Fiona, but it does seem, at least in those sustainability integrators, that they are making the contribution to doing the right thing where it makes sense for their business model. And we're up against time. I've got 1 minute, I think. I'm just going to ask you perhaps both to just reflect on the sort of tips that we put at the end around alignment, accountability, understanding finance and technology. Anything that you want to pick out there if a director's listening on the call, and sort of says, where should I start? This seems like a good conversation to have in my company. What should I do? Any reflections there? And perhaps I'll start with Sandra before we wrap up.
I just maybe as an example, I shall just share my experience with Fluxys. So we started because it's an interesting experience, because we, in the meantime, since we have started the sustainability reflection, a lot of things have changed, of course, geopolitically. And so we started rather early to reflect on the change of the business model, because we had to, because of the declining role of natural gas, of course. So we're an infrastructure partner for the people who don't know the company. So we transport and we store molecules for the Belgian market, and we also do transmission, terminaling, and storage. And so we started rather early, because natural gas is about to disappear anyway to a big extent. So we accelerated since 2018. Now, all of you know that between 2018 and 2022 to 2023, a lot of things happened. So we had to review a little bit our approach. And so at board level, what we did was very interesting, because I think we used your 5 tips. We all implemented them. We started by really aligning the board, the management, the whole organization. And from a practical point of view, we did this through strategy sessions once or twice a year, but also through expert sessions. So we really had, at a certain point in time, it was every month or every 2 months, we had expert sessions with the whole board, where the expertise of the whole board was leveled up with regards to the energy transition. So we redefined the purpose of Fluxys to shaping together a bright energy future. We really made the board accountable for the whole strategic exercise. We made sure that there was sufficient understanding through the whole organization. We also redefined the leadership structures with an enlarged operational management team, and including the vice president, strategy and sustainability. So we linked strategy and sustainability within the organization. We are a listed company, but we are our share reference, our main shareholder is the Belgian state, so that makes it a little bit more easy. Of course, it's not the Belgian state, but it's public authorities, and then of course we moved on with the CSRD reporting. So we used everything we could use from the data to put the transition, the progress forward. So I think it was a very interesting journey, and we defined an investment plan of more than 8 billion between 2025 and 2034. So we had to slow down a little bit since 2024, because we are also responsible to the energy security in Belgium and also partly in Northwest Europe. So we had to slow down a little bit the investments, but nevertheless, and despite the difficult situation geopolitically, we made the first investment decision in 25 for the first hydrogen infrastructure in Belgium. So we moved on with the investment plan. And so I think we were able to do all this despite the difficult circumstances, because we managed to have this alignment throughout the company, also with the shareholder on the transition of the business model. So I think that's the first step to do, is to make sure that the whole organization is aligned around the purpose, and you have to work top down and bottom up at the same time.
What a great case study. I think you touched on all the areas that the tips that we have there. I also want to reflect on.
I tried to do it very rapidly, but
No, that was fantastic. I just sort of we actually had another question in which talked about long term versus short term, and I think Sandra, your case study also set out essentially what quite a long term investment plan you've got. Probably not long term in terms of capital expenditure on fixed assets, but a 10-year investment plan shows that you need to take that long term view too. Fiona, any last comments from you before I hand it back to Beatrice?
No, I mean, I think the big unlock is in finance, but to do that, you first need to do exactly what Sandra outlined. This is accountability. This is everybody has a role to play in mobilizing the organization, and then very deep dive on finance. But yeah, fantastic to hear about the progress that they are making.
Excellent. Thank you to both of you. Thanks to both our panelists. I haven't got time to sum up other than to say I hope that brought to the audience that brought to life some practical experience of how some of the issues in the report that we've outlined are playing out. And for me, there was a lot of congruity there, and some great examples. So thank you for your attention. Thank you for your questions, and I'll hand back to Beatrice.
Yes, thank you everyone. Thank you, Sandra, Fiona, and Jill, for the very useful conversation that we had, and thank you to you, Andrew, for the good moderation. And I would like to quote Fiona saying that boards and investors remain solid in their conviction. I think this is certainly the positive message of this webinar. And it's clear that real progress will come from the chair conviction of businesses that sustainability creates value. So we look forward to continuing this journey with you, the audience. Let's stay in touch with ecoDa anyway. Thank you very much.